Hey everybody, it's Ed Zoller, Villa Realty Group with my second market update. This is the market update for January. I've compiled all the data and the graphs so you don't have to and broke it all down. The nice thing about this is the second update, so we can not only compare long-term averages from in the past, but we can also compare month to month to see what did January bring us in the real estate world. So let's begin with the market update. And as I did last time, I'm not going to read this verbatim. I'm just going to give you some insights on why these data points are important, what you need to focus on. So the premise behind this is the number one question I get asked as a real estate agent is, how's the market, right? A very general statement. If I had 20 minutes to discuss it, I could give you a whole lot of information. I could probably talk about it for hours, but usually we call it our 15-second elevator speech. We're stuck in an elevator. We got 15 seconds to talk. Hey, you're an agent. How's the market? What I would say in 15 seconds is that this market's in a transition phase that we'll probably have for about a year or so until it stabilizes. We need a combination of interest rate decreases, income growth, and price decreases so that the locals can afford a home again. I don't know if that was 15 seconds, but that's what I would say. It's not a buyer's market or a seller's market. I call this a transition market. So if I had 20 to 30 minutes to discuss and the capabilities of showing you graphs and having printouts, the research, the data, and everything else, that's what this update's for. It's to give you a good 20-minute overview of the market so you're better educated, better informed, whether you're a buyer thinking of buying a home or a seller deciding, is it the right time for me to sell? How is the market? Or the reason you would ask someone how the market is, hopefully this will give you that insight. So to inform you, so some of you didn't see last month's update, which you can see on this channel for the end of the year. I'll just highlight. I've written these for a decade plus. Starting in 2007, I started giving monthly updates to investors and owners about why the market was going down and when it was going down and when it was stopping and how far it was going and everything else. So stop doing that from 2016 to 2021. Started doing them again because the market definitely changed a lot since COVID. So being that this is the second market update, not only can we compare the previous graphs, look at the same data points to see how they changed over the course of years to years, but also look at it from month to month. You know, what did January really bring us? So that's going to show signals of stability. Have we gone down? Is the market surging? The demand of buyers coming in? Is the interest rate hike? What did that do? What is the potential future interest rate decreases by the Feds? What that's going to do? When it's going to happen? All of this hopefully it can be highlighted in this update. So what we're going to do is go through the same data points we went through last time, and I'm going to do that as fast as I can here. So first data point we did before, and we're going to do again, is supply and demand. Don't have to tell you what supply and demand is. Supply can be looked at from homes that needed to be sold, and then obviously we look at the solds to see what demand was for condos, townhomes, homes in Southwest Florida to give an overall look. So first thing we're going to look at is what happened in July and what supply do. So as you can see in this graph, from compared to last month to this month, our inventory growth year over year was 99%. We're still second to Charlotte County, that is leading Florida of all counties right now of an increase of 152%, and that's from January to January. So you can see a little bit of slowing up. You can see how steep that curve is. But if you look at the long-term average of 6,100 homes for sale or 6,200 homes for sale, and see that we have 9,300 homes for sale, well, that's starting to get into record highs. You know, you can see in 2018, when we did have a little bit of a dip in 18, middle 18, we had over 10,000 homes for sale, and the prices started going down a little bit. But as you can see here, we're really close to that, and it's only in January. This is our season, and that's why you see those little humps preview to the COVID crash we had. You can see in 2016, 17, 18, and 19 how the inventory builds and builds and builds, and then the demand gets really high starting in January, February, March, April, May, and the demand goes down, 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 down until it rebuilds again in the summertime. So if we go back to that trend, we are continuing to climb in inventory. As a matter of fact, when you look at it, we have almost a 50% surplus of inventory, more than what we've normally had over a long-term period of time. So that kind of pinpoints towards next month a price decrease, knowing that this is season. February is going to tell us everything we need to know. Yes, it's the shortest month of the year. I think this year is leap year, so maybe it's 29 days, but we should see increased demand. We should see supply starting to hover and peak out and should not be a steep incline. So I'll be really curious to see, do we hit the 10,000 home mark? Do we exceed that 10,000 home mark, and how much by? And that can kind of give you an indication of whether our market's going to be becoming more toward a buyer's market or continue back towards a seller's market. So let's look at demand. Long-term average, we sell about 1,900 homes a month. That's where you can see how this all charts out. You can see still those 3 peaks of demand, usually around March and April, where we have the highest demand ever. It starts going up in January and it starts exceeding. And unlike 2021, 2022, 2020, 2019, we should be going up in demand. And instead, it's a steep decrease down. 933 homes sold is a very low number. As a matter of fact, I have to go back to the 2000s to see the last time we only sold 933 homes in Southwest Florida. So definitely on a downward slope. Demand is record lows. Supply is not quite record highs, but getting there. And all of this could be setting records in a negative format if you're a seller, in that our prices will probably have to go down. This is always, for me, a precursor to predicting the future of the market and what next month's going to look like. And because this is supposed to be our season, this is when demand should be getting close to its peak. March will tell us that did we hit a high, but if this continues to drop like this is just telling you that buyers don't want these prices. Buyers don't want your home, and buyers aren't buying. That's why our supply is going up. Very simple to comprehend once you kind of look at it all and try to put it all together. But as you know, supply and demand are just 2 different ones. But as far as January, end of January, record low demand, we should have seen this starting to go up, but instead it went down to well below long-term average. So why? Why are buyers not interested in homes in Southwest Florida? Well, it goes back to that house payment as opposed to income. And we did this last month as well. As you can see, long-term average is around 26% of someone's gross income, household income going up. So when I said earlier that our market's going to be dependent on interest rates and pricing, it's also dependent on the average growth. If everyone starts making 10 grand more a month, then they have more to spend and they can afford more of a home. But that's not the case. Our household income actually is kind of leveled off right now. Right now, it's at $73,914 as far as the Census Bureau right now. And that number does change month to month. You're going to see some of these numbers change because not only when a number changes, the long-term average also changes just slightly. But overall, looking at this graph overall, you can tell that people can afford everywhere from 16 to 24% of their gross income for a home. What they can afford is 45, 46, or anything near 40% of their gross income on a home mortgage. And that's where we're currently sitting right now. But we can use this. We're at 42%. Last month, I think we were at 45%. So it's getting better. It's going in the right direction, but obviously not fast enough for you to really see anything. But this does explain to me why demand is at a record low, because we're still way over 40% and we need to be more around 20-something%. So just like I did last time, I do math so you don't have to. In 2006, when we hit 45% last time, and we corrected towards that 23 and actually overcame that and went into the teens, we can actually take today's household income for Lee County, that's sitting at that 73,000, and see that even at the highest where people could sustain a house was 26%, then that's $1,601 a month. Just doing the math. That's what people can afford. That's what's going to bring back demand. So either we have a price household income increase, we have a price decrease, or interest rates will make a house $1,600 a month. And that's all of this will make a market stabilize and then start to grow again. Markets don't grow just because. Markets grow normally because of people making more money. If you make more money, you can afford more of a home, and the home prices go up. And that's kind of symbolizing by this graph here of why that line is fairly straight from 2009 all the way to 2021. But to see how steeply it increased. And that was a lot to do with interest rate, but it had a lot to do with our prices being way too high, much higher than they were last time. So let's take a look at that. So our average home price. So if you expect demand dropping to an all-time low and supply really booming up, then you would expect home prices to crash. The problem is it's not. It's only going down slightly, although you can see year over year that last crash was pretty steep. This one's kind of more like a plateau. Over the course of doing this over the next 10 years, this graph is going to kind of even out. But we did go down in value. Knowing the rate that the houses on the average are going down is great insight for those of you out there that own a home, because if you're thinking of selling, and you don't stay ahead of this market, and the market is continuing to lose and have negative growth, then if you're not ahead of it, you're going to just chase it all the way down. This is what happened back in 2008, 9, and 10, is people would drop 10 grand, but the market crashed 15. That steep graph. This one's a slower one, so you can see here that our average home dropped 0.5%. It's not much. It dropped 0.8% last month. But 0.5% in a month is 6% over a year. That means our house prices will go from 400 down to 375. And that's if it continues at this. But the funny thing is it doesn't just always go down 0.5%. It's going to change month to month and based on season. I think this number is very low because this is truly our season. This is when demand should be at its highest for the year, and that's keeping the prices kind of stabilized. So it's a couple weird things right now for me. Normally, real estate appreciates at 3 to 6%, as you can see from 2009 all the way to 2019. This little slow, steady train track of a little engine that's just going uphill very slowly. 8 straight years, you have been accurate if you said, hey, I think houses are going to go up 3 to 6% every single year. And you'd be right, 8 consecutive years. And that's kind of what our long-term average says about a stable market. But by monitoring this decrease and this rate of decrease, I can stay hopefully ahead for my clients who are trying to sell a home to try to stay ahead of this market so we just don't chase it all the way down until it stabilizes, whenever that is. So I did this last time. This is the math part. I'm going to more speak on why I do this again. But it did get better for buyers, although not as fast as you would like to see. So if I take that $394,000 home, that's down almost $5,000 from last month, and plug in today's interest rates, which went down a little bit, 6.2 from when I actually wrote this, which is the end of January, then that monthly payment with principal, interest, taxes, insurance on the average home is now $2,902. Why did buyers not want to buy homes? Because they're only saving $9, but it's a step in the right direction, but $9 does not make or break a buyer on a monthly payment. We are far exceeding that $1,600 a month that we calculated that the people can afford. So doing the math on this, if I take that 394 house and I only dropped interest rates, I'd actually have to drop interest rate not by 0.4, but 2.4%. That'd be under 1%. And that would make 394 average price work. But that's not going to happen. You know that. If we only drop price and left interest rate alone at 6.2, then the drop in price is a 50% drop in value of $197,000 to an average base price of $196,000. That's not going to happen either. The realistic approach is that income will go up slightly, interest rates will drop, and prices will drop. But if we did say let's drop interest rates to 5%, then home values would only lose $177,000. Now, compared to last month, with all those averages changing month by month, that actually gives buyers a little bit more of a buying power as opposed to if you would have bought in the beginning of January as opposed to buying in February, a $17,000 buying power. That's what's good about looking at these month to month and seeing how these numbers change. This is how the market's going to correct itself. We're not going to crash $200,000, but we are going to have these three things playing their role till we can get to that magic number, which is maybe if income goes to $78,000 and people can afford $1,700 a month, and then between interest rates and prices, it will get there, and then we'll stabilize. And then, of course, doing the numbers even further, if we go to 4%, the prices will be a base price of $250. But compared to last month's projection, the base price would have had to be $225. So actually, see, that's good for sellers. It's correcting in both ways. But we eventually still always have to get back to buyers have to be able to afford a home. So the reason this changed is because figures, like I said before, change month to month. The average household income is calculated monthly. And so when I pull in that data, it changed. Obviously, the long-term average will change as long as things are either high or low. But last month's update, I kind of showed you when our bubble popped, which was June of last year. The other data points are there to either say whether we're slowing, stabilizing, it's slowing up, it's speeding up, or what's going on. So we want to look at some of those key point data we looked at last month as well and kind of compare it month to month. So days on market's actually pretty good. This is an indicator whether houses are taking longer to sell. And you can see historically from 2016, 17, 18, those little peaks of those mountains always tend to be right around July. July, August, the middle of summer, hurricane season. It's hot. It's 95 degrees in Southwest Florida. It's not a great time. It takes longer to sell a home during those months as any other time. But normally, as you can see in January, March, it doesn't take that long to sell. Now, I will say this, 2021, 2022, and 2023 were flukes, absolute flukes of a market. They were FOMO buyers, the fear of missing out buyers, the threat of the interest rates going up, the lack of supply due to all the investors buying homes and Zillow buying homes and cash buyers and all that mess. So I don't really take any data from COVID to that. I look at the previous data to say this was a normal, predictable market. And we could always say it takes longer to sell in July. That's going to be a true statement again. And it's going to take shorter times to sell or at the lows in March. And right now we're just kind of at long-term average. So this is more or less a graph that we don't really care month to month or whatnot, but it does tell you a trend of the market. And we want to see that trend where this is actually getting lower. I'd love to see days on market get under 65, but with all that growing inventory and lack of buyers, these things are just going to sit on the market a little bit longer is my prediction. So the biggest graph I can ever show to really show how's the market is this home value growth month over month for Lake County. So we track this so we can pinpoint the changes and it will signal whether we're at a crash or a bottom or what's going on. And we can track how long it's in a certain position to kind of tell you a little bit. Now let's go back in time. Let's go back to 2005 and 6. As you can see here, month over month growth value, great, 28, 32%. For 38, I think we gained at 1 month. It was crazy. The market just cruised and the prices went to 300 grand. And as you can tell here, it crashed. It went below 0%. And for 59 consecutive months, it kept losing. It lost its most 2 years after it crashed by losing 28%, and then started kind of rebounding back around 2012. That's history, and that we can prove as a fact. And as you can see here, it's stabilized. We were growing at 8%, 9%, 5%, 3%, even as little as 0.9% is still growth. But then all of a sudden, nowhere, we gained 31 and 32% again. And you can almost see an almost exact comparison to 2006 peaks and 2023's peak. And we are now currently sitting at negative 5% growth. We were at negative 8, like I said, last month. But this now counts as 6 consecutive months where our homes have lost value. And what's important to track that is how long is that going to take? When is that going to get back to zero? And how much lower could it go? Last time we crashed and people couldn't afford homes, and between interest rates and prices and everything else, we were negatives for 59 consecutive months. So welcome to the first 6 months of that. If you think it's going to continue, I hope not. But if it continues to look like this is kind of a graph to kind of pinpoint that, hey, it's still going down. So if you're patient, you got rewarded. And the longer it sits below that 0% line, the more patience will reward you until we can either A, get a time machine, get some interest rate that existed a long time ago. And that's what we're going to talk about a little bit about with builders later on, and how we can get a monthly payment that you can afford, even in today's prices and today's interest rates. But this is going over the averages. So in brief overview of this, and just saying this, you can read this on your own when you look at it. But so the start of our season, we should have seen demand start to rise. We saw rapid demand shortages. Our market did not pick up as anticipated. Our busiest time of year is in the next 4 months. And this first month of this boom, we didn't see anything. As a matter of fact, we saw historically, we've never, except for in 2009, we've never been negatives in January as far as growth goes because of that demand increase. But here we are. Supply went up by 14% in the month of January. So we definitely gained more supply on that. In perspective, normally this time of year, our inventory grows at 2%. So we can compare that and say, we're 7 times normal. We should just be gaining 2% in supply, and we gained 14%. Demand dropped 20% in the month of January. And I did say January is the start of our season because that's the closings. If someone doesn't buy in January and close in January, normally we just lose 4%. We lose the most in June, July, and it starts getting lower and lower until we actually gain demand. But normally we just lose 4% being on the tail end. This is when buyers come in January, will close in February and March, and usually we see an increase of demand. This time we lost 4%. I'm sorry, we lost 20%, but normally we only lose 4%. The home values dropped by a half a point, yet we're still way over 40% of gross household income, which we have proven people can't afford. And all of this pinpoints towards a trend to say that will next month be better. These data points predict no. A lot of you asked me to add data points to this, and I thank you all for your feedback and what you thought of this update. But what I wanted to add to it was the rental outlook. A lot of you wanted thinking about renting for another couple years, or maybe just one more year, and want to see what's going on with rent. But there is also a historic reason for me to look at rent as a market analyst. And that is because historically, the rental market corrects and stabilizes well before the housing market does. But it is a signal that the real estate market, the sale market, will stabilize after that happens. So if the rental market stabilizes, then we can have a positive outlook on the real estate market that soon, whenever that is, months, half a year, that we will stabilize. But before that time, we will not stabilize the housing market unless the rental market stabilizes first. So let's look at that data point. So I did graph out the rental rates for Lee County. And as you can see here, even during the last boom, 2006, 7, and 8, rent didn't really go up that much. It went up total of 13%. Household income, went up about 6 of that. So even though we boomed in pricing, the rental market didn't really go up that much, but it did go up. And then it crashed down to, I think the lowest rent we ever had on the average was $984 a month back in 2010. But we can still look at the figures and look at this long-term graph and kind of look at what happened in 2022. What really happened? You see that kind of slow, steady incline from 2016? More people were buying homes, more investors were buying these homes. As the prices of homes were going up, they needed a little bit more in rent, and they were doing these little bumps every single year. And if you look year over year at the numbers, rent went up $50, and it went up $50 again, then it went up $50 again, and then it went up $50 again, and then all of a sudden in 2020 after COVID, it went up $100, then it went up $400, and then another $300 from that. We peaked out in 2023 with the average rent going for $22.50 in a county where we can calculate what rent should be as well, based on some long-term averages, and we'll be doing that in a little bit. But the rent rate now dropped much further than the housing market, which is a precursor to what the housing market should do. That rent has done this. This is all positive. This is all good news that rent is finally going down. But as you can see, still way elevated up there. So what I want to do with these numbers is kind of say, okay, we've had many, many months where rent's been going down and the rental market's looking good. Did every landlord get that memo? Probably not. So your particular landlord might still think the market is great, but as you can see here, not on the average, it's not. If we take rent as a percentage of household income, like I did with the houses, we can see here the long-term average, I think, is right around 29%. And we can say 29% of someone's household income goes towards rent. And that's what they can afford. That's been what's sustainable. And as you can see from the actual numbers, that graph is pretty close. Even during the crash when houses were cheap and the rent was the cheapest, it was slightly over long-term average. And then it kind of hovered and got closer and closer. And in 2016, 17, 18, and even that 19, it was pretty much 8% of someone's income. That's sustainable. But look what happened right at 2020 COVID. Rent peaked out around end of 2022 and has been going down ever since because it exceeded that. So it's 20% higher than it should be. we can calculate, we take that same household income, we calculate the long-term average that people can afford to rent, and we should be renting houses at $1,700, but instead we're renting them at $2,200. That's the current one right now. Yes, they peaked out higher, but this looks like a trend that the graphs are converging back to one another and should go back to that nice thing. Will they dip below? Well, last time we crashed, it did. So we should be probably renting places for $1,500 again. When? Well, that gap in those two graphs there, don't know how long that's going to take, but you can see from that slope, that might be many more months. It might even take this whole year until that stabilizes out. And that will give us an indication that whether our real estate market will stabilize or not, we'll have to first see this stabilize. So this will be an interesting graph I'm going to have in every other update coming up. So the big question a lot of people ask is, what if I take the old graph of percentage of household income for houses that we've looked at before, take the same graph of rent? Well, there's something interesting that comes out when you look at this graph. And if you're driving and listening to this, I'll kind of explain. The question I get a lot is, should I just buy or should I just rent for now? And I think this graph really, really indicates, is it a good time to buy or sell? Look at the red graph. That is home prices versus household income. In 2005, it was so much more expensive to buy than it was to rent. And what happened after 2006? That graph started going down. They crisscrossed in 2008. That was also the sign of our bottom, but that bottom lasted for 4 years until 2012. And then as you can see, even in 2012, that home price kind of stabilized back up. And you see that gap? You see how long from 2008 when they crisscrossed to the last crisscross is 2021, it was actually better to buy a home than to rent. It made sense to do that. But now since 2022, 2021, middle, those graphs have now crisscrossed again. And now it is 40% of your household income to buy and 33% of your rent, of your household income to rent. Both very elevated. So I do believe you're going to see these graphs both go down. And eventually that housing graph will crisscross. That will be the sign of our bottom. And that's why it's important to look at this. It's the crisscrosses that matter. What do the crisscrosses mean? It means that at that particular time, it was the same to rent and buy. So most people go to wanting to own if it's the same as rent. But if it's cheaper to rent, of course people are going to want to buy. What stopped them? Either their lack of knowledge, didn't think they could qualify, or maybe their credit needed to be worked on, or maybe they just didn't have any money for a down payment. But this is another data point that I can start looking at month to month and really just look at the relationship of these graphs to see which one, when are they going to crisscross. That should signal a bottom, just like it did in 2008. So let's recap. Supply has gone up 14% compared to 2%. It's currently 50% higher than our long-term average. So we got lots of supply. The buyer demand even hit a lower number, and that we haven't seen since prior to the 2000s, so 20 years plus ago. There is a data point, and I'm going to probably have graphs on this, but Mortgage Brokers Association, or MBA for short, does track down in an index form, in a number, about mortgage applications, refinances, and they look at that they going to tell loan officers it's bad out there, it's dead, it's great, it's busy, and everything else. So I did start looking at that. Currently, that index is sitting at 218, and that number doesn't mean anything by itself. I'm going to start adding this so you can see where that demand is. When you get an uptick of applications for a mortgage, that means in 30 to 45 days later, after they make that application, they're going to be buying a home. This is a good future predictor whether our demand is going to go up or not. And it did uptick, but it upticked from a number that was a 40-year low. So it had nowhere to go but up. I think that 40-year low was right around 180 and change. So up 40 points is not big. To give you comparison, we had an all-time high in March of 2020 of 1,172 on that index. Long-term average is 600. That's an average normal market that's sustainable, and we are at 200. So obviously applications, because homes are unaffordable and too much of gross income, applications dropped a lot. I think next month there'll be an interesting graph to kind of see as a future predictor whether demand is going to be picking up in the next month or two. So average wage earner still has to spend over 40% of their household income, although it's not 45, it's 42, so that's in the right direction. Our home prices are still far higher than what they need to be affordable, but they did go down. and that's a good start in the right direction. We did have a small drop in interest rate, although the market just did that. I think it's already rebounded back up again, but that changes every day. But that's kind of where combinations are going to be making it more affordable for people. The days on the market went from a record low of 30 days. Of course, that was the FOMO, crazy fear of missing out market, and we're never going to see that again. The long-term average is 60. We're right at long-term average, and the month-over-month growth in sales currently negatives. That's 6 consecutive months of negative growth. And when you see a pattern like that, that number, I'm really interested to see how big that number can be and how much that will grow, because that will tell us everything. But I think we have some data now that we can kind of look at to kind of do a little bit of prediction, to do a little bit of data analysis to see how the market is. You see how I can't do this in 15 seconds? It's a lot to take in, but I have to always prove my points. If I say the market's not doing great, or if I say it's a buyer's market, the data will say it's a buyer's market. The month-to-month stat, and I add a couple more things in here, but just kind of comparing January. What I did is I took that slide from January 1st and I put in February 1st numbers up to date. You can see the total homes for sale went up by 1,200. That's a huge increase. That's a lot of homes. That's 1,000+ homes that hit Southwest Florida. Our solds dropped. Our pendings went up, though, and pending sales is when someone goes under contract but not quite closed. Every one of you who bought a home, we were under contract at one point. That actually ticked up, and that's really good. And the new home construction, although the arrow was showing down, it only went down 6, which means builders still have a whole lot of new construction to sell, quite more than they've ever had. But the little slow down tick, we'll have to keep looking at that to see if that can ever get down to about 1,000, under 1,000 again. But 1,600 homes is a lot of homes for builders, and that's who's kind of driving this market right now, because they're becoming more and more distressed. The median asking price went up. This is a weird one for me. Now, I'm also looking at median asking price. So a lot of homes, that either tells me one thing. A whole lot of high-end homes, above average homes, went on the market maybe in January to make that median go up. We gained so many homes that it's good to look at the median on that, but it going up also pinpoints one thing. But as you can see, the selling prices went down. The median selling price in Lee County is at $379,000. That's a pretty big drop compared to the median selling price in Lee County. And then obviously, as you see, owners are not getting 100% of asking price or over asking price or bidding wars. And that percentage also has gone down from 95 down to 94% of asking price as an average. So overall, you kind of just take all of that to say more homes, a lot of homes just hit the market in January. The solds have dropped. The pendings are up. The prices, the median asking price is up, but that's an asking price, not a selling price. The selling price is low. The asking price is high. That might show you a little bit of disconnect for owners that still think it's last year or still think it's 2022. And that's what I'm seeing a lot in the market. Owners still think their house is worth $500,000 because their buddy sold one a year and a half ago of the same house. Or people who bought new construction in 2022, 2023, and 1 year later they want $200,000 profit. It's not there. All of this kind of pinpoints to our market being in transition. It's transitioning toward a buyer's market. It's still a seller's market in a way if you're comparing 2020 to now, but it's definitely not a seller's market comparing it to last year or the year before. But that's what all these data points kind of pinpoint towards. So my big breakdown is very simple. I just clap my hands. You can't see me. Demand drop, inventory soared, homes taking longer to sell. It's a transition market, like I said. To my sellers out there to think it's too late or thinking of selling, remember, if you bought pre-COVID, if you bought even prior to 2021, there is still that, quote, fake equity that was gained artificially in the bubble pop years. But now that I'm tracking how much it goes down, if you were to go on the market, we can stay ahead of this to get out of this market still with that equity until that market stabilizes again. And that'll be our new bottom. It is very predictable, as you can see from the previous graphs. Our Southwest Florida market is super predictable. We know when they come. We know when the houses sell. We know when inventory increases. We know that locals have to be able to buy homes to sustain our market. And that's what we're seeing right now is the locals can't. If all the New Yorkers and Californians and in my opinion, the myths out there of all these high-end buyers are coming down right now, where are they? Why didn't they buy homes? Why is our average selling price, if they're buying all $1 million mansions, why is our average selling price plummeting like it did? that should have been higher if they're just buying the high end. At the end of the day, they're not coming. It's probably because they can't afford it. Or B, if they're smart cash buyers, about 1 out of 3 of our deals are cash buyers. Do they really want to buy a depleting asset? Would you buy a stock as it's dropping? That's why I don't really see a lot of investors jumping all over this market right now. It just doesn't make sense. Just like it doesn't make sense why end users aren't buying homes because they just can't afford it. So obviously the data, a couple other things I had in here: U.S. Census Bureau, Zillow.com, the Federal Reserve economic data. It's called FRED. You can look up all these websites. Obviously, our Southwest Florida MLS is our local board of realtors, the Mortgage Brokers Association, or MBA, and Realtor.com. Great data collecting sites. Everyone talks about Zillow being the god of real estate with their estimates and their average and what they're talking about. Just remember, they are data collectors. Their main business is selling leads of buyers to agents, and that's how they make their money. But they do have great data. They do keep track of some things that would just be impossible for me to do on my own. So of course, I'm going to give shout outs to where I collected the data, and you can see all these things for yourself as well. And then obviously, I want your feedback. I added this MBA graph. I'm going to be adding the MBA graph as my own design, but if you think of any data points that you'd like to see or curious about anything real estate related, or how this might impact the market, please feel free to reach out. As you know as well, I can get this data and I can do these updates very quickly, including out of state, out of county, out of zip codes, and others, wherever you want. Recently, someone had me look up Charleston and Marion County, Indiana. I have no idea where those are, but they had me look them up, and I was able to get the same data points from those. So if you're ever curious, you can drop me a line. This will be invaluable to people who ever can maybe have a house somewhere else to see how that market's doing. Are they in transition? I will give you this: not every county and not every state is going through what Southwest Florida is going through, but many also are as well. And some of those states would shock you. They don't have anything to do with Southwest Florida. No, it's still not the same drive, experiencing the same thing. They do have one thing in common: they were hit hard by investors, and they were hit hard by the Wall Streets out there with those cash buyers, artificially inflating the prices. Obviously, COVID affected the whole country. A lot of supply drops. So the same reasons we crashed is a lot of reasons other people did. But there are some states and counties that the average income can totally afford those homes, and I can of course share that with you. And of course, if you ever want to reach out, get out with me, you got my email, ed@villarealty.com, teacherscanbuyhomes.com. It's my one site that I'm going to start putting these updates on, but I'm actually going to be focusing on my YouTube channel, this YouTube channel. So if you ever don't want to miss one of these updates, maybe a midterm update, like midweek thing, if there's something I think that's important that you should know, you can always subscribe to that channel and hit the bell icon so you're notified. Obviously you're watching this on my YouTube channel, just Ed Zoller, my name. But I look forward to hearing from all of you. I'd love to hear your insight of what you thought about this market update, and I appreciate you guys taking the time to listen to me out.